Everyone tells you a $200,000 house is a big asset. Buying property is the key to building real wealth. They're wrong, but what if I told you a simple $10,000 stock investment could outpace that house with zero midnight plumbing calls? The real math paints a very different and frankly shocking picture. We're about to follow two friends, Alex and Sarah, on a 25-year financial journey. They both start with the same $10,000. Sarah does what the gurus say and buys a rental property. Alex tries a simple investment in the stock market. What happens over the next 2.5 decades will challenge everything you think you know about building wealth. First up is Alex. He's done with the noise. He takes his $10,000 and dumps it into one thing, a low-cost S&P 500 index fund. He's essentially buying a tiny piece of the 500 most powerful companies in the American economy. No board meetings, no inventory, and zero employees. Historically, this boring move has churned out a 10% average annual return. Alex's total workload? About 5 minutes of clicking buttons. His total out-of-pocket investment? Just that first $10,000. From here on out, his money works for him while he sleeps. Then there's Sarah. Sarah wants something she can touch. She wants the landlord title. She takes her $10,000 and uses it as a 5% down payment on a $200,000 starter home. This is where the gurus start screaming that magic word, leverage. On paper, Sarah looks like a genius. She's controlling a $200,000 empire with just $10,000 of her own cash. But leverage is a double-edged sword, and Sarah just grabbed the blade. Her financial story doesn't end with that down payment. It begins there. She's now staring down a 30-year, $190,000 debt obligation. Before she even sees a dime of rent, she's on the hook for property taxes, homeowners insurance, and the silent killer of real estate, maintenance. We're talking $2,000 to $4,000 a year just to keep the roof from leaking and the furnace from exploding. That $10,000 wasn't an investment. It was an entry fee to a second job she didn't know she applied for. While Alex's money is a silent engine, Sarah's house is a hungry beast that needs to be fed every single month, whether she has a tenant or not. The stage is set. One friend is playing the game on easy mode. The other just signed up for a 25-year marathon. Who do you think hits the finish line first? If this math war between stocks and real estate is starting to flip your perspective, do me a favor. Hit that like button and subscribe to Wired for Money. Now let's keep the momentum going. We've seen the setup, but the real question is, what happens when the golden years meet hard reality? We're 10 years into the experiment. Let's look at the scoreboard. First, the lazy visionary Alex. His $10,000 has been sitting in the S&P 500 untouched and unbothered. Using that 10% average, his account now reads $25,937. Here's the punch. Alex has spent exactly 0 hours managing this. His return on effort is essentially infinite. He's had 10 years of weekends, zero tenant drama, and if he suddenly needed $5,000 for an emergency, he could have it in his bank account by Tuesday, though he would have to pay capital gains tax on his profits. Alex has growth, but more importantly, he has mobility. Now look at Sarah. On paper, she looks like the winner. Her $200,000 house, riding a 4% appreciation wave, is now worth $296,000. Between the price hike and 10 years of mortgage paydown, her equity has exploded, but here is the dirty secret of real estate. You cannot eat your kitchen cabinets. Sarah is technically wealthier, but she's house poor. Her wealth is trapped inside 4 walls and a roof. Over the last decade, she's had to find 3 new tenants, chase down late checks, and shell out thousands for a water heater that decided to quit on Christmas Eve. Her rental income, it's basically a pass-through. After the mortgage, taxes, and repairs, she's barely breaking even on cash flow. On paper, Sarah's net worth is growing, but her reality is one of constant management, stress, and very little financial flexibility. Alex's journey has been one of pure passive growth. But wait, before you declare Alex the winner, there's a massive plot twist coming in the next decade. Sarah is about to get a tax gift from the government that Alex can only dream of. The question is the tax break worth the headache? Welcome to the second decade. This is where the math gets messy and the lifestyles diverge completely. While Alex's portfolio took a few hits during the inevitable market pullbacks, he did the hardest thing in investing. He did nothing. He didn't panic sell. He didn't even check his login. His wealth is a silent snowball. Sarah, on the other hand, is dealing with a lifestyle leak. Her property is hitting that 15-year mark, the age where everything starts to break. We're talking a $3,000 plumbing disaster and property taxes that keep creeping up like a slow-moving predator. And then the ultimate nightmare, the non-paying tenant. Sarah didn't just lose rent, she spent 6 months and thousands in legal fees on an eviction. Alex's stocks never called him at dinner to tell him they weren't paying their dividends. But here is where the plot twist happens. Sarah finally pulls out her secret weapon, the IRS. You see, the government wants people to be landlords, so Sarah gets to play by a different set of rules. She's deducting mortgage interest, property taxes, and every single repair bill. But her biggest win? Depreciation. She gets to tell the IRS her house is wearing out and use that paper loss to shield her other income from taxes. For a high earner, this is like finding a cheat code for your bank account. Alex has a tax win too, long-term capital gains, meaning the government takes a much smaller bite of his profits than they do from a regular paycheck, but he doesn't get the landlord shield. So here's the million-dollar question. Is Sarah's tax-free growth worth her stress-filled life? We're about to hit the 25-year finish line, and the final numbers are going to expose a truth that most real estate gurus are terrified to talk about. The 25-year clock has officially stopped. It's time to open the books and see who actually built a life of freedom and who just built a mountain of paperwork. Let's look at the lazy visionary first. Alex's original $10,000, that one-time 5-minute decision, has snowballed into $108,347. His profit, $98,347. He didn't lift a finger. He didn't answer a phone call. He didn't even have to know the S&P 500 existed for 24 of those years. For Alex, money was a tool that grew in the background of his real life. Now let's look at Sarah and get ready, because this number is going to make every real estate guru scream from the rooftops. Her $200,000 rental, appreciating at 4% a year, is now worth a staggering $533,000. After 25 years, her remaining loan balance is about $87,000. So her raw equity is a jaw-dropping $446,000. And what about the rental income? Let's do the math. We'll assume she collected rent that increased by 3% each year, but also had to pay for maintenance, property management, taxes, insurance, and the mortgage. After all those expenses are paid by the rent, she was left with a net cash flow profit of around $57,000. So Sarah's total profit is her equity of $446,000 plus her cash flow of $57,000 for a total of $503,000. After paying off the bulk of her mortgage and adding in 25 years of net rental profit, Sarah is sitting on a total gain of $503,000. On the scoreboard, Sarah didn't just win, she annihilated Alex. $503,000 against $98,000? It's not even a contest. But wait, before you go out and buy a rental property, you need to see the invisible ledger. Because while Sarah has more money, she might have actually made the worse investment. Think about the financial burden. Alex's total career as an investor lasted 5 minutes. Sarah's lasted 25 years. Sarah also started with $10,000 out of pocket. But to get her profit, she was responsible for paying off a mortgage and covering decades of expenses like taxes, insurance, and repairs. Even though rental income covered these bills and left her with a profit, her total financial burden was massive. She managed over $1 million in total transactions, collecting rents and paying bills. She was the CEO of a small, high-stress business. She dealt with broken pipes, legal battles, and shifting tax laws. Sarah didn't own an asset, her asset owned her. If you divide her profit by the thousands of hours of stress, phone calls, and management, her hourly rate starts to look a lot less like a tycoon and a lot more like a minimum wage worker. So, which one was actually smarter? The answer depends on one thing that most people value even more than money. So the million-dollar question, who actually won? If you define winning by the size of the bank account, Sarah is your champion. But if you define winning as return on effort, Alex didn't just beat her, he played a completely different game. Here is the cold, hard truth that real estate moguls hate to admit. Alex's path was the smarter investment. Sarah's path was a successful second job. Alex used his $10,000 to buy freedom. His 1,000% return came with zero stress, zero debt, and zero liability. His wealth is liquid. He can spend it, move it, or hide it in seconds. He avoided the triple T trap: tenants, toilets, and taxes. For pure, passive wealth creation, the stock market isn't just an alternative, it's the superior engine. So what about Sarah? She didn't invest in a house, she started a business. She used the power of leverage to control a $200,000 asset, and it paid off massively. But she paid for that profit with her time, her sleep, and her peace of mind. She was a CEO, a property manager, and a debt servicer. The wealthiest people don't actually choose one. They use the stock market to build their foundation and real estate to shield their taxes. But they never confuse the two. So before you sign that 30-year mortgage, ask yourself, do I want to be a landlord or do I want to be free? At the end of the day, the best path isn't the one with the biggest number. It's the one that fits your version of a rich life. Do you want to build a business empire, or do you want to be a passive investor who can walk away at any time? So what's your $10,000 move? Let me know in the comments, are you hashtag team stocks or hashtag team real estate? I read every single one and I'm curious to see which side of the math you're on. Check these videos next to get wired for money.